Fed policymakers know they have to start raising interest rates given the low unemployment rate and inflation at 40-year highs. And they're expected to move today, even though the wisest course of action might be to delay until the impact from the war in Ukraine on the U.S. economy is more clear. Joining me on the morning show, Joe Krier with IIWII Trading. Hey, good morning, Joe, and thanks for joining us.
Hey, Bruce, thanks for having me.
Of course. So the obvious question for consumers is, okay, higher prices are already straining our wallets. How is increasing borrowing costs going to stomp down inflation?
Yeah, well, I mean, the market has anticipated these rate hikes because the Federal Reserve's done a great job of telling people they're coming. But, you know, if you have $25,000 of unsecured debt, you're going to pay about $3 more a month. And that doesn't seem like a lot. But if the Fed raises rates 7 times this year, then you're going to have things adding up on you a little bit.
Yeah, so the Fed's main tool to battle inflation is interest rates. Let's see how this impacts a variety of things. Let's start with credit cards.
Yeah, I mean, you know, the average credit card rate right now is above 14%. And actually, that's the worst kind of debt to carry in any environment. But environment when interest rates are going up, that's really going to hurt you. So if you are carrying that, you definitely need to target that and start whittling away at your highest card as quick as possible. Maybe take advantage of a 0%er here promotional rate and get that thing paid off.
If you're buying a car, you used to be able to dicker at the auto lot, but cars are in short supply. You know, you're going to pay above sticker. How about the impact on auto loans?
Yeah, it's a seller's market, you know, and they can kind of get you from a variety of angles. And unfortunately, the financing rates are one of those. And we know that rates go up quick. When the Fed raises rates, everybody else follows in line, you know, within a couple of days. And today is a day.
Not a lot of homes on the market either, and home buyers are paying a premium, and mortgage rates are already inching up. What's this going to do to mortgages?
Yeah, you know, we've seen kind of a mixed bag there. You know, as long as you have a fixed rate mortgage, you're okay. But if you have an adjustable rate or a home equity line of credit, home equity lines adjust immediately when the Feds raise rates. So you would see a higher interest rate starting tomorrow, perhaps, if you have home equity lines. So just keep your eyes open and maybe talk to the bank about rearranging things a little bit.
So my 17-year-old Emily is shopping school. She hopes to get a scholarship, but you always have to think about student loans. Could this impact those as well?
Definitely could. You have to be careful and make sure that you're looking at good quality lenders. And most of the time you can get your student loans on a fixed rate and stretch things out a little bit. But if you're doing a private loan, you know, it's a common thing for people to use home equity to pay for college. And in that case, you're definitely going to see some adjustments. So again, it's a good time to maybe take an inventory of what your debt is, what's adjustable, what's fixed. And sometimes you can push adjustable rate debt over to a fixed bucket and just lock yourself in.
So I know the school of thought is if the Fed makes borrowing more expensive, it might discourage investments. That means less demand and it may hold down prices. Might it have an indirect impact on supply chain issues?
Yeah, I think so. You're right. And it is a double-edged sword. The whole point of this is to slow down activity before prices get too far out of control. And supply chain is a big part of that. I mean, if interest rates are higher, anybody who borrows money, shipping companies, as a good example, usually carry a lot of adjustable rate debt. So their cost of bringing the goods to the grocery store goes up, and that gets passed on to the consumer. So it's kind of a perfect storm. We will feel this effect from a variety of angles, as we kind of already have started to.
And how long before we might see an impact there?
Yeah, you know, you could say we're in the middle of it, and the trends that we're seeing, unfortunately, will probably get worse before they get better. I don't know if gas gets to the highest projections out there, but that's definitely going up, and food is probably not going to go down by any stretch. So this is a trend that we're in, and we need to get used to it.
Yeah, especially with wheat and grain, you know, coming from the biggest suppliers over there in Ukraine. Joe Krier, always appreciate your perspective. Have a great day.
Thanks, Bruce.
It is 7:45. Time for a look-see at the weather.